Have you ever wanted your money to make you money? Well, you came to the right place to start. In this video, I'll break down the basics of investing step by step so you can understand how to start, where to put your money, and how to grow it for the long term. Now let's talk about the main types of investments to get this all started. The first is stocks. When you buy a stock, you're literally buying a piece of a company. If that company grows and becomes more valuable, so does your investment. But stocks can go up and down a lot, which means they can be kind of risky at times. Next are bonds. Think of bonds as loans. When you buy a bond, you're lending money to a government or company, and in return, they promise to pay you back with interest. Bonds are usually less risky than stocks, but the returns are often smaller too. Then we have funds, like index funds and ETFs. These are baskets that hold lots of different stocks or bonds. Instead of betting on one company, you're investing in dozens or even hundreds at once. For beginners, funds are often the smartest choice because they give you instant diversification and lower your risk. Step 1. Build a safety net. One of the biggest mistakes beginners make is investing money they can't afford to lose. Before putting a single dollar in the stock market, make sure you have an emergency fund, usually 3 to 6 months of living expenses set aside in cash. This way, if life throws you a curveball, you won't be forced to sell your investments at the wrong time. Step 2. Choose the right account. Now, how do you actually invest? The first step is opening an account. If you're in the US, that might be a brokerage account with apps like Fidelity, Schwab, or Robinhood, or a retirement account with a 401k or IRA. The account you choose matters, because retirement accounts often come with tax advantages, while regular brokerage accounts give you flexibility to withdraw money anytime. Step 3. Start simple. Next comes the fun part, deciding where your money goes. For most beginners, the smartest choice isn't trying to pick the next Amazon or Tesla. Instead, start with index funds or ETFs. These have a much lower risk and can save you from having to guess which single stock will win. Step 4. Automate and stay consistent. Once you pick your investments, set up automatic contributions, even if it's just $50 or $100 a month. The key isn't timing the market, it's time in the market. By investing consistently, you take advantage of dollar cost averaging, which means you're buying a little bit whether prices are up or down. Over time, this smooths out the risk and helps your wealth grow steadily. Step 5. Think long term. Remember that investing is a marathon, not a sprint. Don't panic when the market dips, because it will. Historically, the stock market has always recovered and grown over the long term. If you stay patient, reinvest your earnings, and avoid pulling money out for short-term reasons, you'll likely come out far ahead. So here's the recap. Know your goals, build an emergency fund, open the right accounts, and start with index funds. Automate your contributions and think long-term. That's the foundation of investing. If you found this helpful, hit that subscribe button for more money tips, and remember the best time to start investing was yesterday. The second best time is today.